Stock markets. One of the first things to understand about stock markets is that stock markets refer to shares of stock that are traded in what we call the public domain. Um, Most corporations, when they are first formed, are privately held, and the shares of ownership in that corporation may be held by only a few people. Some corporations become very large, and they're still privately held for a very long period of time. When corporations go through the process of making the shares of ownership, the common stock shares of ownership in their companies widely available to the public, we call that an initial public offering. It's the process that a company goes through to sell its stock to the public. It's a very complex series of events that are required in order to make it happen. Usually companies have to hire some outside help in the form of an investment bank. And when the company first sells shares to the public, the money from the sale of those shares go to the original shareholders and those that own the shares at the time that it becomes publicly traded. After a company has gone through an IPO and its shares are publicly traded, individuals who are not connected with the company in any way can buy and sell shares from each. We refer to this as the secondary marketplace. So if, in this example, if IBM issues stock through, or sells stock through an initial public offering, an IPO, then that stock is now in the public domain. And if someone named Bob owns 100 shares of IBM stock and now sells it to a guy named Jim, IBM is not involved in that transaction. The money and the stock just transfer between those two individuals. So it's called secondary markets. Usually these trades take place in something called stock exchanges. Stock exchanges provide a very, very efficient way for individuals to buy and sell stocks and to generate liquidity or cash very quickly. By bringing buyers and sellers together, we eliminate all of the effort that would be required in trying to sell shares of stock in IBM. By going to a stock market, there's another individual there who might be trying to buy and you're trying to sell, and it all just kind of gets plugged in together. There are a large number of stock exchanges throughout the world. The most well-known, most prestigious, and oldest of those stock exchanges is known as the New York Stock Exchange, but there are many others, both in the United States and all around the world. Most developed countries have one. The way that trades occur is different depending on the type of stock, where the stock is listed, etc. But usually an individual places an order at what we call the retail level. And so if you decide you want to buy shares in Google, for example, you'd place that order, and that order goes through a system, and there's some way of matching up buy orders and sell orders together, and depending on the marketplace you're participating in, it happens a little bit differently. In some stock markets, there's an individual called a dealer, and he actually maintains inventory in stocks and will sell and buy them. And he will sell and buy them at slightly different prices and keep the difference. And we call that a bid price versus an ask price. And there's usually a spread or a slight difference between the two, and he'll keep that. So this dealer may or may not be someone involved in your transaction, depending on the market that you're participating in. Usually many times there's someone called a commission stockbroker. His job is to help get the best possible prices for his customers, and he has a methodology for doing that. Sometimes we bump into an individual in the process called a market maker or a market specialist, and their job is to make sure that stocks continue to flow from buyers to sellers by sometimes stepping in and filling in gaps in trading and making sure that the market kind of marches forward in sort of an orderly fashion. Brokers generally just try to match buyers and sellers together, and they don't have their own stock inventory that they're selling trying to keep a spread or a difference between the bid and the ask. Usually, these individuals just try to match your sell order with someone else's buy order. Lots of places out there that you can get information about publicly traded stocks. There's a lot of wonderful online resources out there. Most of them draw their data from the same sources. Usually they come from Multex or Reuters. And a lot of the data that they have also comes from the EDGAR database, which is part of the Securities Exchange Commission. Companies also provide a lot of information about their stocks through what we call their investor relations department, and most publicly traded companies have one of those. Lots of wonderful information that you can get out there on publicly traded stocks, and most of it is free. A couple of examples of places that you might go if you need information about publicly traded stocks. You can go someplace simple like yahoo.com and select their finance page, and it has all kinds of tools there for you to look at a publicly traded stock. And you can go to a specific stock exchange, for like NASDAQ, for example, and you can get information there. There are periodicals such as the Wall Street Journal that publish information, and it's all freely available to you. One thing that you may want to familiarize yourself with is some of the activities surrounding publicly traded stocks with regards to what we call financial analysts. Analysts issue recommendations, and they publish expectations on how they think publicly traded companies are going to perform. And those sets of expectations are fairly important, actually, in helping to influence investors and whether or not they buy or sell certain shares of different publicly traded stocks. If an analyst comes out and says that he expects a company to double its earnings per share in the next quarter, there's probably going to be some sort of an effect on the stock price when people hear that. And so there's a lot of interesting things that you can go out and find for yourself and look up and learn to read. Some people really get in depth in their analysis of publicly traded stocks and do a lot of what we call fundamental analysis, which is analysis that centers on the actual operation of the business, the financial performance of the business. Some individuals spend a lot of time focusing on something called technical analysis, which has more to do with analyzing patterns of behavior with the stock price going up or down over time. There's lots of different ways to look at publicly traded stocks, lots of different types of analysis. You should probably familiarize yourself with at least the basics so that you're conversant in the vocabulary and you can understand at least some of the basic parts that we're discussing.